Roaring Kitty turned $50,000 into $50 million. Do I have your attention yet? I've dissected his whole investment approach in this video. You're watching More Money, let's get it. What's up everyone? Thanks so much for tuning in. If you're new, I'm Tay, a 20-year veteran of the investment game. I provide a ton of sound and well thought out investment content. For example, I told you in one of my recent videos that the whole Gamestop squeeze became something way bigger than just a short squeeze. Too many people rushed into it, it received way too much press coverage, and that was an indication that you need to rush out of it before it imploded. And of course, as these things do, it blew up bad, with lazy bag holders losing up to 90% of their investments. And that's enough of patting myself on the back and a roundabout way of saying that this channel provides a ton of great content, so to make sure you don't miss anything, hit that subscribe button. Also, don't forget to hit that notification bell so you're notified as soon as I release a new video. So over the last news cycle, you guys probably heard of Deepfknvalue or Roaring Kitty. Both of them refer to the same person as it was involved with the Gamestop short squeeze. It was actually 34-year-old Keith Gill. I was happy to discover that he is exactly the basement dwelling nerd that we all hoped he would be. And also, he's a Star Wars nerd, which is shown by his constant use of the term "this is the way," a line from The Mandalorian. That's also a show where my friend Baby Yoda became famous. And I know his name's Grogu, but I'll never call him that. He's Baby Yoda. Get over it, guys. So the shill media will tell you that he placed a $53,000 YOLO bet, which turned into as much as $50 million at one point. And I'm here to say that that wasn't a YOLO investment at all. For those of you who don't know, YOLO, you only live once, used as an investment term, is referred to as something where someone takes a huge gamble on a stock position with a huge chance of loss and the potential to hit it big in your favor. So, for example, taking 50 grand and turning it into 50 million. It is the equivalent of mortgaging your house and betting it all on double zeros at the roulette table. The truth, however, is that Keith's investment was well thought out and it fell right into his investment strategy wheelhouse. Also, you'll be surprised at how similar his investment approach is to billionaire Warren Buffett's investment approach. So how exactly does Keith invest? Well, good news is he's actually part of the YouTuber community. He goes under the name Roaring Kitty, and he actually outlined his investment approach in the video that I've linked in the description. He has a 6-step investment approach. Number 1, he looks for a huge discount to the company's true valuation. In order for him to find the true valuation, he'll start by looking at the financial statements and the operating results and go as far back as possible to see what this company generally can earn. When he's coming up with the valuation, he's not going to waste a lot of time trying to figure out the exact valuation. He just wants to get an idea of exactly where it should be trading at. And this makes a lot of sense because valuation requires a ton of judgment and estimates. Two really intelligent people can reach two different conclusions on what a company is actually worth. I actually agree very much with this approach of just using a rough estimate. I also don't like to waste my time when I value a company, so I look for an approximate value as well. For example, I value the shares of Facebook at around $600 a share. That means that it might be really worth 500 or 700. It doesn't really matter so long as it's currently trading in the 200s right now, which means that it's about less than half of what I think it's worth, or at least close to that. So I like it and I'll buy it. If something's really difficult to value, for example, if it's not making income or if it's going through a turnaround, he'll actually look at insider buying as an idea of if the stock is trading at a discount or not. And this is actually a very brilliant strategy because there's a lot of reasons why an executive would sell their shares, but there's only one reason why an executive team would buy shares in the company, and that's to make money, and it's because they believe that the shares are cheap enough. If that reminds you of anyone, you're right. Warren Buffett also looks for a discount. He's termed it the margin of safety. Now, personally, I like a 50% discount or better. Right now, my home builders that I recommended in a previous video, although they have traded up by about 12 or 15% since I made that and released that video, but they're still trading at somewhat of a discount because Wall Street hasn't yet picked up on that investment thesis yet. Give it a few months, it'll happen. There's very low home inventory in the US, interest rates are low, and people are willing to locate further away for work because of the work from home culture shift. I really like to stick to that 50% principle, so if I see a stock trading at like 60% of its true valuation, I'll just do one of two things. The first thing I'll do is absolutely nothing. It's totally acceptable to just not take a swing. The market will always throw another pitch at you. In other words, there will always be another company that might be trading at a better valuation. 2, if the stock's really volatile, I'll actually sell puts at the price that I think it should be trading at and collect a premium on whether or not it gets there. And the reason why I would do that is because if the stock is volatile, you might get a good premium on selling a secured put at a price lower than the current price. And if the stock continues to take off, no worries, you still got a reasonable amount of premium, so no matter what, you made money. By directing yourself to look for a minimum of a 50% premium, you are forcing yourself to buy a lot fewer securities when prices are expensive and buy a lot more securities when prices decline. Roaring Kitty actually talks about this, where he says that when the markets are really down, like back in March, he was buying hundreds of stocks. And obviously when markets are more expensive, you're more in cash because you're just not finding opportunities. I also agree with this because back in 2020, I found that stocks were so cheap. I was buying so much that I was having trouble affording groceries. And now that we're in February 2021, because things are expensive, I'm in a sizable cash position and I'm getting fat. So this whole lesson can be summed up in one sentence that Warren Buffett has popularized, which is be fearful when others are greedy and greedy when others are fearful. Don't buy a lot when the stocks are expensive and everybody's jumping into the market, and buy a lot when everybody's struggling and they just want to sell it all out. You're the one who's going to buy it. Investment criteria number 2, Keith does not shy away from leverage. Just because a company has debt doesn't mean that he'll immediately walk away from the security. In order to assess the credit risk, he'll look at the yield on publicly traded debt, as he believes that the bondholders do a lot of good work. He also looks at potential covenant breaches. He looks at rating agency reports. He also looks at who owns the debt, because by determining who owns the debt, he can figure out what they're going to likely do if the company breaches the covenant and goes into receivership. So you might ask, why exactly is he assessing the credit risk of the company? It's because he's looking for really huge returns. So he'll dabble in companies that are going through seriously hard times, and if they manage to not go bankrupt, their share price will jump considerably, a la the Gamestop situation. It's actually called deep value investing, and that's exactly what he did on Gamestop. Plus other considerations, because it was being heavily shorted, it set the company up for a short squeeze if there was any particular good news on the name. Criteria number 3, he looks at insider buying. He loves to see that the executives are buying shares. The more shares that the executive team is buying, the better. And the reason for this is because, like we said before, there's a ton of reasons why executives will sell shares. There's only one reason why they'll buy shares. If executives are buying shares as the share price has dipped and gone to a very low level, it actually is a very good indicator that they believe that the shares are undervalued. It gives him more confidence in a situation that he's already starting to feel more and more confident about. And a solid complement to insider buying is his 4th criteria, which is that he looks for insider ownership. He likes to see at least a minimum of a 20% ownership of a company by executives. He did mention that high ownership is not necessarily the best thing, because that could be like a family-run business with multiple classes of shareholders, which may not necessarily be the best for the general shareholders. But in most situations, if it's not a family-run business, it's got 20% executive ownership or more, it's probably a good situation where the executives and the management are acting like owners of the business, which is good for you as a shareholder. I personally agree with him on both points. Insider ownership is great, but watch out for those concentrated family ones with multiple classes of shareholders. It could hurt you. And they do those on multiple classes of shares to maintain control of the voting in one class, which is not floated out to the public. That's not necessarily the best thing in the world, because then the public doesn't feel like their vote is being counted, which in actual fact it's not. Also, for him, insider ownership doesn't just mean the executives of the company. He also looks to see if respectable value shops are buying it. If there's good value oriented investment firms that are also buying the name of the security and they're jumping into it around the same time, it tells you that there might be some serious value in this name. Criteria number 5, this one's actually brilliant. He looks at credible internet researchers. The problem with Wall Street analysts is that they're not exactly independent. The investment bank hires the analysts typically based on whether or not they have a banking relationship with the client or want one. The secret of Wall Street is that most equity research analysts aren't actually fully independent, even though they claim that they are. They are paid based on how profitable the banking, trading, and debt volumes are with the clients under their coverage universe. Analysts are constantly hired and fired based on how profitable that relationship is. So this causes the analysts to not be overly critical over the companies that they cover in their universe. And I have a lot of friends on Wall Street, some who watch this video, and I apologize if I offended you, but I'm not gonna lie to the people about how this really works. So if you can't use the research of analysts at investment banks, what alternative is there? Well, the internet is riddled with extremely smart people who write blogs and have YouTube channels. So Keith scours the internet looking for people who are putting out credible information. When he finds something that he likes, he actually does something pretty brilliant. He will read the article or watch the video and decide if he agrees with it or not, and then he reads the comments in the comment section to see what other people are saying about that article or video. This is brilliant because that comment section will provide him more insight into determining whether or not that article writer or video maker is credible. As he says, it's a lot easier to write a comment on a video as opposed to actually putting out the content yourself. So you can actually find very smart people in the comments box. In fact, even in the comment box of my videos, you find really, really smart people messaging really great things. Now, before I go into the final investment criteria, if this video has brought you any value, please smash that like button. It really helps out the channel. Also, my next video will be about how federal governments are quietly stealing your money and what you can do about it. So if you don't want to miss out on that video, please hit that subscribe button and ring that notification bell to be notified when I upload that video. So Keith's final investment criteria is an emotional one. It's how confident he feels about the possible investment opportunity. Because he's diving into distressed companies, there could be a lot that goes wrong, simply due to the high degree of uncertainty. So he relies on his gut and feel when he makes that position. And when he makes that position, he holds on to that position with his diamond hands and holds it all the way through, just like what he did with Gamestop. If you want to know how I managed to not pay down my student debt, click right here. If you want a playbook on how to manage the next stock market crash, click right here. Thank you very much, everyone, and I'll see you later.